Inflation is on the rise again, hitting 3% in January, higher than expected. Markets reacted immediately, stocks tumbled, and bond yields spiked. But what does this mean for your investments? And more importantly, how can traders capitalize on this volatility? Stick around because we're breaking it all down. Here's what happened. Inflation in the US unexpectedly rose to 3% in January, up from 2.9% in December. Food and energy prices surged, and now traders are questioning whether the Fed will delay any interest rate cuts this year. Stock markets reacted negatively, with the S&P 500 and Nasdaq seeing a pullback. Meanwhile, Treasury yields saw their biggest jump of the year as investors priced in a longer period of higher rates. So why did inflation rise? The biggest culprits: food and energy prices. Gasoline prices rose 4% while food costs jumped 2.5% year over year. Now, inflation staying elevated at 3% complicates the Federal Reserve's plans. Many expected the Fed to cut rates by March or May, but with inflation still sticky, rate cuts could be pushed further out. That's why markets are panicking. Traders had priced in a Fed pivot, now they might have to wait longer. Let's talk about how different markets reacted. The S&P 500 closed lower as investors reassessed the likelihood of interest rate cuts. Tech stocks took the biggest hit. High-growth companies tend to suffer when borrowing costs stay high. Meanwhile, Treasury yields surged. The 10-year yield jumped past 4.3%, its highest level this year. This signals that investors expect higher for longer interest rates, which can keep pressure on stocks, particularly in rate-sensitive sectors like tech and real estate. Now the big question: how can you profit from this shift? Here are 3 ways traders can play the market right now. First, short overvalued tech stocks. Tech companies have been rallying on hopes of lower interest rates. If those rate cuts get delayed, expect a pullback. Look at companies with high debt loads as they'll struggle more in a higher rate environment. Second, buy commodities and inflation hedges. Rising inflation usually boosts demand for gold and oil. Gold is already testing $2,050 per ounce, and oil prices could rise if inflation fears persist. Consider adding exposure to gold ETFs or energy stocks. And third, trade the bond market shift. With Treasury yields rising, bonds with longer durations are losing value, but short-term bonds and Treasury ETFs are becoming more attractive. Keep an eye on T-bills and inflation-protected bonds, known as TIPS, as safer alternatives. This inflation spike has completely changed market expectations, and traders who adjust their strategies early will have the advantage. Are you buying gold, shorting tech, or looking at bonds? Comment below and let's discuss. And don't forget to subscribe for more market updates like this. Stay ahead of the game. I'll see you in the next video.